Whoa, buddy. Put that thing back in its holster. We haven't gone anywhere.
I don't understand.
Check out the MichaelDukesShow.com for information on how to get access to the podcast.
Welcome to the party, pal.
The Michael Dukes Show.
The greed and the entitlement is astounding to me.
What more could you want from a low-budget radio program?
This is a dumpster fire.
That was just BS.
It is time to get a new perspective.
We know just what you need, and we've got just the cure. Open wide and prepare for a steaming hot cup of freedom.
I just don't fathom it.
The Michael Dukes Show, streaming live across the world.
Live around the world on the internet at michaeldukeshow.com and across the state of Alaska on this, your favorite radio station and or FM translator. Hello, my friends. Good morning. How are you? Are you ready for Truth Tuesdays? Yeah, I know. It's all going to be good. We're all ready to go. We're going to jump into it here in just a second with Brad Keithley for Alaskans for Sustainable Budgets and the weekly top three. And then in hour two, we'll have some recap with some of my thoughts. And then we will finish up with our inspirational visit with Chris Story for that beautiful uplift that we'll need by the end of today. So that's all coming up here this morning, and we are getting ready to go. Did you miss me? Did you miss me yesterday? It's a long day yesterday. Long day, boy. I tell you what, it was interesting, but it's good to be back home. Good to be back home. And it's amazing how much a place like this could just kind of get into your blood. And all I could think of while I was away was, boy, I can't wait to get home. Can't wait to get home. So here we are, ready to go, ready to rock and roll. And let's just jump into it, shall we? Get things started this morning. Brad Keithley, of course, is with Alaskans for Sustainable Budgets, and he comes in every week to give us the scoop, the rundown, the straight dope, the painful truth on what's happening around the state of Alaska, and he joins us this morning. Good morning, Brad.
Michael, how are you doing? How's Homer today?
Homer is good. We're a little snowy today. Had a good drive back yesterday. I flew into Anchorage and did a Costco run, and then came straight back down here. And it was nice. It was sunny, beautiful day. A little bit of snow, and then last night we got another inch of snow. In fact, there's a whole. I should have mentioned it. There is a winter weather warning. Is it winter storm warning? Anyway, blowing snow advisory for the eastern half of the peninsula today. Expecting an inch. It's not hugely, but anyway. So it's beautiful. It's beautiful. And you, my friend?
I'm doing great, Michael. I'm doing great. I'm in Illinois visiting my mother, and we went from snow 2 days ago. It's like Fairbanks. We went from snow 2 days ago to it's supposed to be 70 degrees this afternoon here. So it's like one of those Fairbanks spring things.
Man, it's like this psychotic weather, we just can't decide, man. We're schizophrenic all over the place. All right, Brad. Well, let's dive into this. You got some good topics for today, and I'm looking forward to it. The first one is we talked a little bit about this last week, but you dove a bit deeper into this in your weekly column, talking about exactly how much money are we leaving on the table with the PFD or the PF, the Permanent Fund Corporation, and the POMV draw. And you've got some questions. So hit me with it here.
So last week we talked about the permanent fund balances, what the permanent fund balances would have been had the permanent fund been invested in S&P 500, in the S&P 500 index through an electronic traded fund into the S&P 500 index. And the numbers were surprising. I went back to 2020, and it showed that in every year except one, the S&P would have produced significantly higher returns for the permanent fund, as opposed to how the Permanent Fund Corporation had invested the funds, and that the balance for the permanent fund would be significantly higher today, even starting in 2020, would be significantly higher today, nearly double what the balance of the permanent fund is had it been invested. Over the course of the week, I kept thinking about that, and I got several questions about, well, what does that mean in terms of money? What does that mean in terms of the POMV draw? What does that mean in terms of how much the Alaska revenue side would realize had the permanent fund corporation invested the funds differently? And so I dug into that, and I went back to FY13, because the way you calculate the POMV draw is it's the average of the first 5 of the preceding 6. It makes sense if you think about it. The first 5 of the preceding 6 years, the average permanent fund balance. And so you can't just start in, say, you just can't start recalculating in, say, 2019 and know what the 2019 POMV draw would have been under alternative investment. You have to go back to FY13 actually to be able to do that, to July 1st, 2012, to be able to do that calculation. So I did that. I went back to July 1, 2012, and looked at what the permanent fund would have looked like had it been invested in S&P or the S&P 500 or some variation of the S&P 500, a 90-10, the Buffett rule for investment, 90% in the S&P 500, 10% in bonds, had it been invested in those. And the numbers are just flooring. I talk about them in last week's landmine column for people who want to dig into the details, but the numbers are just jaw-dropping. I mean, so we started on July 1st, 2012, the beginning of FY13, with the same balance as the permanent fund had, and said, okay, up to then, everything's the same. And that balance was about $40 billion. Thank you. And that balance was about $40 billion. And then we started building the permanent fund through investment in the S&P. And there's a publicly traded fund, VOO is the trading symbol for the Vanguard S&P 500 fund that tracks the S&P 500 index. And so we said, okay, so what if it had been invested in VOOs as opposed to the way it was invested? And Michael's got the chart up on the screen. The blue line at the bottom, the line, is what the permanent fund did over that period. And the red line is what the permanent fund would have done. The permanent fund balances would have been over that period had it been invested in the S&P 500. In only 1 year, did the S&P 500, did the permanent fund outperform through this entire period, through this entire 13-year period? In only 1 year did the permanent fund outperform the S&P 500, and that was in 2022, FY 2022, when the S&P dropped, but so did the permanent fund. The permanent fund balance just dropped a little bit less. But using those balances, then using the balances we constructed out of the S&P, we looked at what the permanent fund draw would have been, and that's what the bars are at the bottom of this chart. And the reason they begin in FY19 is because that's when the POMV draw began, and that's the period that we can start going back to FY13. That's the period that we can start using the average of the 5 of the preceding 6 year balances. And the blue bar is what the POMV draw was from the permanent fund. The red bar is what the permanent fund draw would have been had we been using the S&P 500. And the differences are just stark. I mean, beginning in FY19, the POMV draw, had we been invested in the S&P 500, permanent fund, the POMV draw would have been $470 million more than the actual POMV draw based upon the permanent fund balances. That's 17%. FY20, the difference is $760 million, 25%. The draw would have been 25% higher had we been invested in the S&P 500. FY21, the draw would have been $1 billion higher. Just the POMV draw would have been $1 billion higher in FY21, 35% above what the actual POMV draw was. FY22, the POMV draw would have been $1.5 billion, nearly $1.6 billion higher in FY22, 50% above what the PFD draw. So you go on out, and by the time you get to FY26, FY25 is a $2.74 billion difference. The POMV draw would have been $6.39 billion versus $3.66 billion. And FY26, the year we're looking at, the POMV draw would be $3.25 billion higher. It would be $7.08 billion versus $3.8 billion, 86% higher. So what you figure out from this is the Permanent Fund Corporation has been investing basically to just sort of hold its own. If you look at the blue line, you can see it sort of flat lines across this entire period, while the S&P, if it had been invested in the S&P, while it climbs substantially. The Permanent Fund Executive Director, Devin Mitchell, was before Senate Finance and got asked about why didn't you invest in S&P? And the answer basically was volatility, that the S&P is more volatile. And that's a significant insight into what's going on in the Permanent Fund Corporation's mind. They're scared of volatility. And so they're investing in a way that doesn't have much volatility, doesn't have much variation. And what you're getting out of that is that flat line, the blue flat line that crosses all those years without much significant growth. They're just sort of holding their own. And they're paying something like $860 million this 12-month period just ended at the end of December. They're paying $860 million in fees, basically cover your ass fees, to get advisors and managers to build this fund that doesn't vary much. Well, variability is not a bad thing as long as the variability is generally high, is generally up. And that's what the S&P line is showing you, that if you invested in the S&P, yes, it's more variable, which means it changes more year to year. But the volatility has been up, with the exception of 1 year. And even then, when the S&P corrected down by 10% in FY22, it still stayed significantly higher than the Permanent Fund Corporation level. And this is part of why this number flatlines, the Permanent Fund Corporation flatlines. Instead of paying $860 million in fees, like the Permanent Fund Corporation is doing to cover your ass, managers and advisors to tell you how to avoid volatility, all you would pay in fees for investing in the S&P 500 through VOO, through the Vanguard S&P 500 ETF, all you would pay in fee is 0.03%. And that 0.03%, even at the much higher balance that we're showing in FY25 and FY26, that 0.03% would be $50 million in fees compared to the $860 million that the Permanent Fund Corporation has invested. So what I think we've done with the Permanent Fund Corporation is we said, look, we want you to be riskless. We want you to take no risk. We want you to keep the fund growing a little bit, but we'll tolerate a loss of return to avoid volatility. And the consequence of that is that we've foregone these higher returns. If you look at FY25, that $2.74 billion difference in the POMV draw would have been more than enough not only to pay a full PFD without really breathing hard, but also to cover additional expenses like we're hearing now about deferred maintenance and about additional K through 12 spending. We're leaving money on the table the way the Permanent Fund Corporation is managing the permanent fund. And to my knowledge, we've got no one looking at it. I mean, what you have a revenue commissioner for in government is to look after revenue. He's not supposed to be looking after other things. He's supposed to be looking after revenue. And when you look after revenue, you're supposed to be looking at things like, am I getting the full return from oil that we should be getting? Am I getting the full return other places? If I need more revenue, where do I Where would be the efficient and equitable way to get more revenue? One of the things the revenue commissioner should be looking at is this very thing. He should be looking at, is the permanent fund corporation producing the kind of returns that we could get off this money? Are they producing the type of POMV draws, the type of revenue generation that we could be getting off this money? To that end, the revenue commissioner sits on the permanent fund board by statute. The revenue commissioner has a seat on the permanent fund board. But our revenue commissioner has been asleep at the wheel on a number of things, but this is certainly one of them. And I think, I think this is just shocking when you look at the revenue being left on the table by the way in which the permanent fund corporation is investing. I'll go so far. One more thing. I'll go so far even to say, I think this is a 2026 election issue. Look at that. I mean, that's $3 billion being left on the table. And I think somebody in 2026 running on replace the permanent fund board is going to get a lot of traction when you start talking about the numbers that are being left behind.
Well, and the other thing, of course, that exacerbates this is they keep patching all these rosy projections into what the permanent fund is going to earn, and it's not earning what they're projecting. What they're saying is a standard projection. Whereas, I mean, you're talking about, the current $80.46 billion value of the permanent fund and the $188 million value of the Vanguard fund just shows you how far they're $108 billion apart after only 10, 12 years. I mean, that's a real problem. And it's not that I want to give more and more money to government, which is what this would have done, but we would at least not be fighting, I think, about some of the things that we're fighting about right now.
Oh, we wouldn't be fighting about the permanent fund dividend. This would cover the permanent fund dividend, the statutory permanent fund dividend easily. There's another thing going on here, Michael. I mean, but here, I'll do it during the break.
Okay, you'll do it during the break. If you want to check out this chart, you can find it over at the Alaska Landmine, or you could come out and join us on Facebook. We got it posted up on the screen right now for you to look at. We'll be back with more. Hour 1 of the Michael Duke Show continues. Number 2 of the weekly top 3 is dead ahead. Back with more in just a moment. Don't go anywhere. We'll return to more Brad Keithley right after this.
Running on 100% pure beard power. Oh, also some coffee. We dip our beard in coffee.
Nice beard.
The Michael Duke Show.
Okay, we're in the break right now. Brad Keithley, Alaskans for Sustainable Budgets. Rob Meyer says in the legislature, we're talking about how the opposite. We're saying the draw rate is too high and encouraging the permanent fund board to invest too aggressively is what they're saying right now. I mean, you wouldn't even have to just invest it. Have one guy going, yeah, we'll invest it all in the S&P 500 and we'll just be fine. I mean, wow.
That's what Nevada does. The Nevada PERS, the public retirement system, their public retirement fund down there, they invested in ETFs. They invested in electronic traded funds, the low charge, low fee funds. And they've got a lot of it invested in S&P. And they got one guy running it and one person doing the books. That's their entire administrative costs. And they're producing returns not as high as this because they don't have it all invested in the S&P 500, but they're producing returns significantly higher than what the permanent fund's returning. I get that people are cautious. I get that people are don't want to risk the money and don't want to incur volatility, as if that's a nasty word. I get that. But what it's done is it's leaving money on the table. It's paying a huge amount in fees. I mean, we're paying 1% in fees compared to the 0.03% we would be paying using an ETF. We're paying huge amount in fees, and we're getting like zero returns. In fact, or very low returns. In fact, the reason we're having this whole discussion about merging the earnings reserve, and that's how I got into this issue. The reason we're having this whole discussion about merging the earnings reserve and the permanent fund corpus is because the permanent fund isn't generating enough money, even enough money to cover the 5% POMV draw. And so the sense is, we need to merge those two funds so we can start drawing from the corpus, so we can keep the 5% draw going, even when the permanent fund is not generating enough in earnings to cover the POMV draw. This would have solved that problem in spades had we been going down this track. I've got to admit that, like everybody else, I've been one of the ones that has said, we need to manage the permanent fund cautiously. But this isn't incautiously. Look at the 13 years. Only 1 year have we had a significant decline in the S&P, and that was more than offset by the growth in the S&P up to that point, and the growth in the S&P after that point. So this isn't incautious. Yes, it's more volatile in the sense that the variation around the median is more active. But when you have a low volatile fund, when you're not investing for growth, you're just investing to avoid volatility. You get what the blue line's showing. You get this sort of flat line that goes across time. Yeah, you haven't lost much, but you haven't grown it. And the consequence of not growing it is you're not getting the POMV draw. The consequence of not getting the POMV draw is we're cutting the PFD instead. We are talking about years of foregone deferred maintenance that we haven't kept up with. We're talking about K through 12, and we're talking about high fees on the permanent fund to maintain this sort of steady, non-volatile, flatlined existence. We need to, as I say, I think a 2026 campaign slogan of "Replace the Permanent Fund Board" is going to be something that if they don't get this under control, and I doubt they do, if they don't get this under control, something we're going to see in 2026. When you look at these numbers, it's unavoidable.
Well, and what really hits my attention here is that even with the supposed volatility, we're talking about the drop in 22 and things like that. I mean, the permanent fund lost about $5 billion, just over $5 billion, and the S&P fund lost about $19 billion. But overall, you'd already made up. There was already a $50 billion difference between the two, $60 billion difference. That was, again, would have still been negligible in the long run, especially with the returns as they are today. It's kind of crazy. We're going to jump back into it. Here we go. The Michael Duke Show.
Public enema number one. Oh, wait, sorry. Public enemy number one, which makes more sense. On the other hand, he's a little bit of a pain in the Michael Duke Show.
All right. We're going to continue here, the weekly top three. Brad Keithley with our Truth Tuesday segment. The big question here is today, I've seen a lot of this hate that's come out for Rob Yunt over this discussion on changing the S Corp, C Corp, LLC designation for oil companies. And there's been a lot of hand wringing. There's a lot of discontent, I guess I should say, on the right over Rob bringing this up. I, for one, am fine with it, but there's a lot of folks out there that are doing it. What are the left and the right both missing on this discussion of this Hillcorp, the Hillcorp rule, or the loophole, as you call it, for the taxation on oil corporations, Brad?
So, Michael, I've been involved in the Alaska oil industry since 1993. And by my calculations, that's something like 32 years that I've been in the industry in one way or another, either directly in the industry or for the last 10 years, sort of monitoring it in terms of numbers and calculations, and in terms of the proposals that come before the table. There are several truths, consistencies over that 32-year period. But one of them is that the Alaska revenue system from petroleum is four-pronged. One is production, one is royalty. That's been consistent over the entire 32 years. The second is that all producers have paid royalty for production from state lands. The second is that there's been a production tax of varying types over that period, but there's been a production tax throughout that period that all producers, regardless of whether it's state or private or federal lands, that all producers have paid into. The third is that there's been a petroleum property tax that's shared with the boroughs, but the state takes a share of the property of a tax calculated on the property invested in petroleum plant and equipment. And the fourth has been there's been a corporate income tax on petroleum companies consistently across that entire period. It's a four-pronged approach, and the reason you have a four-pronged approach, the reason any tax system has more than one way of calculating taxes is sometimes one of the measures goes way up when you're in a high investment period. For example, the property tax will go up high. Sometimes the numbers will go way low. For example, when oil prices drop, the royalty will go way low. Sometimes, because you want to change the petroleum tax, you want to change the incentives, as we did with ACES in 2006, and as we did, or 2007 rather, and as we did with the current SB 21 in 2013. Sometimes because you want to change the incentives, what you're encouraging producers to do, you'll change the petroleum tax. Sometimes the severance tax, and sometimes that'll cause it to go up, and sometimes it'll cause it to go down. Sometimes it'll cause it to flatline, even though oil prices are going up. And so you've got those variations. The corporate income tax has always been sort of a net profits share that Alaska has shared in the net profits through the corporate income tax, has shared in the net profits of the petroleum corporations operating in Alaska. It's been consistent since way before 1993, way before I came on the scene, but it's been consistent since the time that I've been involved. And it is a not insubstantial, this sort of net profits tax is a not insubstantial source of income. If you look at, for those who are really interested in this sort of stuff, if you go to the spring revenue forecast and you look at Appendix A3, which has the breakdown of the petroleum revenue by category, you'll see that petroleum corporate income tax is the third largest source of income projected, over the last 10 years and projected over the next 10 years. The oil and gas royalties are first, projected over the next 10 years are first. Production tax is second, but close behind production tax. And in fact, even with production tax, if Hillcorp were paying the corporate income tax, even with production tax, would be the corporate income tax. And again, it's a four-pronged system to get at petroleum revenue in different ways to make sure the state is getting its share of what those petroleum revenues are. It's not a new system. It's not something we're trying to apply for the first time. It's not something we're trying to penalize a company with. It's been been a basic fundamental part of the overall petroleum system for the last 4 years. Now, the thing about it is the corporate income tax part, the petroleum corporate income tax part, is built in part on the basic corporate income tax as a convenience. When they were building the petroleum corporate income tax, they used the basic corporate income tax as a starting point and then built various widgets on that corporate income tax to calculate the petroleum corporate income tax. And so it's built on this, it's built on the corporate income tax in part, but it's not, I mean, when people think about it as a corporate income tax, it's not that. It's the petroleum corporate income tax. It's part of the petroleum revenue system that we've always had in this state. And so when I see articles, complaining about Rob Yunt about, what's the article that just really, I almost started laughing at. Marcy Sowers, Senator Yunt talks like a tax-loving social justice warrior, not a conservative. When I see articles like that, I just break out in laughter. It has nothing to do with social justice warrior, tax loving social. It has nothing to do with that. It has to do with restoring the petroleum corporate income tax as it applies to Hillcorp in the same way that the damn tax has been there since before 1993, since before I came on the scene. It is to make sure that that fourth prong of the petroleum revenue system applies to Hillcorp in the same way that it applies to everybody else. That the revenue, the net profit share, if you will, from Hillcorp's income in the state is being taken in the same way it's being taken from everybody else. It isn't a tax-loving social justice warrior. It's somebody who's trying to restore the system, conservative, who's trying to restore the system to what it's always been so we don't have to go tax somebody else to make up the difference for the hole that's being blown in the petroleum corporate income tax. The only reason that hole's being blown is because, as I said, the creators, the fathers of the petroleum corporate income tax system, based it on the corporate income tax system as a convenience and sort of built from there. The only reason that we've got this problem with Hillcorp is they've come into a way in the corporate income tax system that isn't captured by the base corporate income tax system, and so it's not captured. We're not building on top of that into their share of the petroleum revenue. They've come in a side door in a way that sort of takes out the base on which the petroleum corporate income tax is built and has allowed them to escape the petroleum corporate income tax. And that's fine. But it is a problem it's a problem that creates a hole in the petroleum corporate income tax system, that fourth prong. One other thing, Larry, personally, I mean, the right, I think, is just cuckoo on this issue. I mean, I think they're just making up crap to complain about. The left is off in their own world. Larry personally writes an opinion piece in the ADN that says Alaska needs to fix its tax problem, all of it. And what Larry says is not only do we need to tax the S Corp, the Hillcorp, as a C Corp, we need to change it to be able to tax them. We need to change it for all of the S Corps. We need to tax all of the S Corps. That's nuts too. What we need to do is we need to make sure that the four-pronged the petroleum revenue system that we've had in this state since probably the beginning of the petroleum industry. I've never traced it all the way back, but probably so, that the four-pronged system stays in place with respect to all of the players, all of the major players. And these people who are complaining about, trying to create new taxes or tax somebody that shouldn't be taxed, that's just nuts. It is a petroleum corporate income tax system. It has four prongs. We need to make sure those four prongs still work. And the reason we need to make sure those four prongs still work is to make sure we don't have to go tax somebody else in terms of PFD cuts or in terms of other new revenue sources to make up the hole that's being created by the way in which the Hillcorp's operating under the petroleum corporate income tax system. So the left's nuts about this issue by wanting to spread it to everybody else. The right's nuts about this issue, about wanting to complain about Senator Yunt trying to bring the petroleum corporate income tax back together again so it can operate in the same way it's operated since at least 1993 when I first got into it.
Well, it's interesting because I would think that as we're not thinking about this in the right way, we're not thinking about this as owners of the resource. You have a finite, a finite limited resource. And as an owner, you want to get the maximum yield out of it that you can while you're going on. And yes, it's not, I mean, it wasn't anything bad that Hillcorp did. They just took advantage of an existing law. If it's not equitable and you're not receiving your fair share as an owner, as a resource owner, you should be looking at that. Absolutely should be looking at that. And that's the problem. They're not looking at it as owners. They're looking at it from a philosophical standpoint of taxes are bad. I agree. I don't like taxes, but as an owner, if I had my own oil well, you damn well better be sure that I was going to be getting all my fair share of that, of my resource that I am allowing you to take out in that way.
And that's the thing people are missing. We've got a four-pronged system to do that. Some people think, oh, it's just royalty. Some people think, oh, it's just royalty production tax. Some people think, oh, it's just royalty production tax and property tax. But it's a 4-pronged system. We've built it. If we hadn't built it that way, if we built it as a 3-pronged system, those prongs would be bigger. They would take more because we wouldn't be collecting a piece of it through the petroleum corporate income tax. And so what we've done is we've created a balanced system that sort of operates through time. As some pieces go up, other pieces go down. As some pieces sort of flatten out, other pieces grow. And you've built this system to sort of over time deal with the revenue source. You take a fair share of the revenue source from the petroleum companies. The petroleum corporate income tax is a key piece of that, especially during the next 10 years. During the next 10 years, the production tax declines. Even though production's growing, the production tax declines because of the way SB 21's set up. And so what helps offset that in the big scheme of things, the way we've set things up, is the corporate income tax. Because that produces higher profits, the corporate income tax takes a higher share of the net profits out of the corporations to sort of offset the decline that's going on in the production tax. And now we're just saying, yeah, we got a wheel off the bus. We're just going to leave the wheel off the bus. So we got this 3-pronged bus going down the road. Bad thing.
All right. Brad Keithley, Alaskans for Sustainable Budgets. The weekly top 3 continues. We've got more coming up in just a moment. We'll be back right after this.
Listened to by more staffers in Juneau than any other show because their bosses told them to. And after what they just heard, oh man, they're going to be pissed.
You're a bad, bad man.
The Michael Duke Show.
Brad Keithley, our guest, Alaskans for Sustainable Budgets, and the weekly top 3. That's why I think these folks are missing it, Brad, is that they're not looking at it through the eyes of, I mean, I could see where they're coming from, the people on the right. I could see where they're coming from in the fact that, lowest taxes are the best plan and, taxes are taxation is theft. And I get all that. But as an owner, if I'm owning something and I'm looking at it, I want to get maximum yield for my limited non-renewable resource. I want to get the most that I can out of it. And if somebody has slipped through and we missed something, and I mean, S-Corps weren't even a thing back in the day, so that's how it got through. There's no blame on Hillcorp. They're just taking advantage of the system as it's written currently. I mean, it just makes sense as an owner to go back and revisit that. I mean, to me, I don't see this as being, again, I'm not a fan of taxes, but if it is my resource and I'm trying to get the maximum yield out of it that I can, that just makes sense. I don't understand all the fervor over it.
And they've built, I mean, again, we've built this system as a 4-pronged system to get at property, to get investment, to get at production, to get at the benefits of production as you produce, to get the royalty share, our ownership share as it's produced, and as an integral piece of the whole system, the petroleum corporate income tax to get at net profits as a part of the part of the share. That is that. I mean, it's a whole system that's 4-pronged that gets at our fair share as you're discussing it from the resource. And we've got this one piece of it that's gone amiss because of the way it was built, because it's built on the foundation of the corporate income tax, not because we decided that we didn't want a petroleum corporate income tax from Hillcorp, not because we decided that somehow we needed to incentivize Hillcorp by having a different petroleum corporate income tax apply to them to everybody else. Just because of the way we built the petroleum corporate income tax on this base of the corporate income tax, that's the reason they're getting out of it. It's not because anybody said, oh, they don't need to pay petroleum corporate income tax. Of course they do. That's one piece. That's one prong of how we get our share of revenues from the oil companies. And for people to say, for Marcy Sowers, who I don't know, and probably is a great person, but that headline is just outrageous. For them to say that somebody trying to get that piece back together again, get the four-pronged system back together again, is a bad person, a social justice warrior. It's just outrageous. That's not what Rob is doing. Rob has been, up until the time he stepped off of the bill for whatever reason he did. Rob has just been trying to, keep the existing system going. And I think that both the left and the right have lost their minds about this. It's a technical thing. It's a technical detail. We've built the four-prong petroleum revenue system. One prong has been sprung because of the base that it was built on. We just need to go back and get that prong back in, so we continue to have a four-prong system that's applying to the total revenue, the total oil flow that's occurring in the state.
It's interesting to watch them. The feeding frenzy over this bill. When again, as I said, I was, I'm okay with it, which I'm sure a lot of my libertarian friends are freaking out about. But again, I'm looking at it as an owner. If I own the resource, that's the lens that I have to look at it through. And if I'm not getting, my maximum yield out of that ownership, then I need to figure out how do I do that? How do I fix that? And like you said, the four-pronged approach is important for that. And if we're missing out on one, then we need to adjust. That is just, to me, it's just common sense. I don't understand why it's so contentious.
It's conservative to go put this piece back together again, to go unspring the sprung piece of the prong of the system as it applies to Hillcorp. It's conservative to do that. We're just going back to what we've always done, how we've always done the taxes for the oil companies. We're just putting one prong of it back together again to make sure it continues to work. If you don't do that, you have to create new taxes to fill the revenue hole. I mean, that's the thing about Marcy Sowers. It just sort of drives me over the edge. There's going to be spending. It's just how we fund the spending. And if we're not funding it as we traditionally, I thought that was the conservative thing, as we traditionally have through the four-pronged approach, we're going to have to go out and tax somebody else. That's exactly what we're doing with PFD cuts. So essentially what Marcy Sowers and the others who are going all crazy about this are doing is they're saying tax the PFD more, take more in PFD cuts, because we don't want to put back together this four-pronged system. We want a three-pronged system for Hillcorp.
Yeah. Kevin says, my guess is that he stepped off of that tax because they were planning to stuff an income tax or some other kind of revenue generation into it, which again is very possible because that's what all the folks in the Democrats in the Senate have been talking about this whole time, is more new taxes as well. Brad Keithley, Alaskans for Sustainable Budgets. The weekly top three continues. We're going to jump back into it. Here we go.
The Michael Duke Show. Not your daddy. Wait, sorry. Not your daddy? Ooh, not your daddy's talk radio. Whew. I was scared for a second. Thought we were going down. Here's Michael Dukes and the show.
All right, we're continuing. Brad Keithley, Alaskans for Sustainable Budgets. Our Truth Tuesday segment continues, the weekly top three. The final question is the Senate going to be the fiscal grownups in the room or not? That's a question. I don't know the answer to it. I can suspect the answer, but Brad, what do you say? What are we talking about here?
Michael, thus far this session, we've had a lot of punting. The governor filed a budget that violated the law because it didn't balance. Nobody seems to care much about that, but the governor filed a budget that violated the law. Had a budget that balanced only by pulling down the CBR. And then once you went out a couple of years, the CBR was gone because we pulled it all out, and he had big zeros, big red marks on out in the future. So he just basically punted. He said, look, I'm not going to try to be fiscally sound here, or fiscally conservative, or fiscally sustainable, or fiscally anything. I'm just going to throw you a budget and throw it into the room and just you guys do something with it. And now the House has done the same thing. I mean, the House has passed the K through 12 bill at least without knowing how the hell they're going to fund it. House passes education bill with $1,000 BSA increases state's fiscal situation grows bleaker. That was the Juneau Empire. The Anchorage Daily News, Alaska House advances school funding boost over doubts about its costs. It just goes on and on and on. And then we're getting other stuff on top of it in terms of school maintenance. And it's just, I mean, these two branches of government, the governor in the first place with his budget and the House in the second place, are just not dealing with reality. They're just throwing it all down the road. The governor threw it into the House. The House is just throwing it into the Senate, an unbalanced budget into the Senate, saying, we don't know how we're going to fund this. You guys figure it out. And the question is the Senate going to be responsible? Is the Senate going to be the grown-up in the room and finally come to grips with these issues that everybody else is refusing to deal with? They say they are. I mean, they say they've got proposals to deal with it. You've got the bill supported by the entire Senate Finance Committee that would reduce the PFD down to 25.75 statutory, and may uses the magic word may, but would theoretically reduce the PFD down to and hold the PFD at 25.75. You've got Stedman saying that, we're going to cut the K through 12 increase down to $600 and some odd million when it gets over to us, and that's going to be a piece of balancing the budget. But even after all that, we've still got this huge deficit, $500 million deficit that's going to sit in the budget. And the question is the Senate, because the House isn't going to do it. The House essentially says take it out of the PFD, cut the PFD down to $750 million or $750 per PFD or something like that to balance it. The House isn't going to be fiscally responsible. So the question really comes down to, is the Senate going to be fiscally responsible? And here's what it's going to take for the Senate to be fiscally responsible. They're going to have to do some cutting. The $650 BSA increase that they've talked about instead of the House $1,000 PFD or $1,000 BSA increase is part of that. They're going to have to deal to some degree with deferred maintenance because they're the ones bringing it up, and do something with the dollars there. But they're also going to have to come up with some revenues. And even if you would accept, which I don't, that it's fair and equitable to come up with, to use 25.75 as the split on the PFD, the split for the PFD, 25 to the PFD, 75 to government. Even if you accept that, they still have a big hole. So they're going to have to come up with some revenues. The closing the Hillcorp loophole, restoring the four-prong, for those who didn't hear the second segment, go back and listen to it again, restoring the traditional four-prong corporate revenue, petroleum revenue approach. That's going to have to be part of it. And that'll get you some of the way there. Going back and looking at SB 21, as we've talked about on the show previously, adjusting SB 21 to get back to the same overall percent of the gross that we've had the past decade. We're not talking about changing the revenue that SB 21 produces. We're just talking about getting SB 21 in this environment that it's in over the next decade, getting it back to the same percent of gross, overall percent of the gross that we had just this last decade, the first decade of SB 21. That's going to need to be part of it. And maybe we squeeze by with just that. And maybe they can get out of town with a balanced budget just by doing that. Cuts, closing the Hillcorp loophole, and revisiting SB 21 and readjusting it in the new environment we're facing over the next decade and getting it back up to the same share of the gross that we've had over the last decade. Maybe they can get out of town with that, but that's just getting them out of town this year. As you look at SB 21, as you look at the production tax from SB 21, it goes down. Even as production is rising, it goes down because of the incentives on top of incentives on top of incentives on top of incentives, kicking in a way that I don't think anybody contemplated when it was passed, kicking in over the next decade. So you're going to have to fix that and get that back up to the same share of the gross, and deal with the incentive issues so that you don't distort the incentive issues, but deal with the incentive issues as you're doing that. You're going to have to do that. You're going to have to restrain spending over the next 10 years. That's going to have to be part of it. And you're going to have to deal with how you're going to get personal tax or a personal tax, whether it's a PFD cut, which is a personal tax, or an income tax, or go back to Ben Carpenter's brilliant, I want to say this about 20 times, brilliant, broad-based, hugely broad-based, ultra broad-based sales tax, which took very little from anybody, but by taking it from everybody, built into some revenue. Whether it's going back to that, they're going to have to deal with that. The House, the governor just isn't going to deal with it. The governor has refused to deal with it. He's out traveling. I don't know what he's doing, but he's not being governor. The Senate just wanted to please all of its constituencies and pass spending on top of spending on top of spending. So the Senate's going to have to kick in and be the adult in the room. But to be the adult in the room, they need to be supported in the things they're going to need to do. Cuts, certainly to the K through 12, to the BSA increase, closing the Hillcorp loophole, adjusting SB 21 to reflect the reality we're in over the next decade, and then looking at how we're going to raise money personally, either through PFD cuts or that's much more broader and would include non-residents and other sources of income.
The interesting part about this discussion for today in this segment was the fact that they're now talking about these maintenance, school maintenance funds and things like this. But again, how much of this lays back on the school districts who have been deferring the maintenance on these things for years? I mean, this has always been a pet peeve of mine, the deferred maintenance. And now they go to the state and say, well, now we're in trouble. Now we need it. Now we need the help. And Jesse Keel actually is even quoted in this article saying that he wants to lift the moratorium on the school bond debt reimbursement. How are we going to pay? I mean, again, there's the who pays thing. Nobody seems to be asking that question. It always seems to be going on like, oh, don't worry, the money will always be there. We'll be fine. A minute, Brad.
Well, deferred maintenance is huge in and of itself. I mean, this is sort of the first time we've talked about it. We may talk about it in subsequent shows, but the standard 3% that the Department of Education applies, that would be $330 million a year at current values. So it's huge. I mean, if we talk about bringing deferred maintenance back in, that's a huge chunk to the budget. Yes, the school district should have handled it. Yes, the state should have handled it before now. But we got school districts we got school buildings falling apart that we're going to have to deal with.
Brad Keithley, Alaskans for Sustainable Budgets, the weekly top 3. He's got everybody stirred up in the chat room, so it's crazy stuff. All right, Brad, thank you so much for coming on board. Appreciate you being part of it today.
Michael, as always, thanks for having me.
All right, folks, hour 2 is dead ahead. We got more coming up. When we return, some of my thoughts on what Brad's been talking about and the whole deferred maintenance thing. Oh, that's a whole thing in and of itself. Back with more right after this. Yeah, I mean, you're wrong, MD. Brad just said it was the governor's fault. I mean, it's a combination of both the governor, not putting it into his budget, these deferred maintenance plans, and the legislature doing their things as well. I mean, the legislature the school boards, they've been pushing this stuff off forever. What the heck? You knew it was coming. And then they look to the state like, well, bail us out, Daddy. That's what they keep coming back to.
Yeah, so it goes both ways. I mean, so deferred maintenance is supposed to be a separate line item. The state has a responsibility. I mean, the state has a responsibility by statute for deferred maintenance. And so the school districts put in projects and the state's supposed to fund them. The state hasn't funded them, so they haven't set the money back to the school districts. Now, the school districts would have had the discretion, to take the money that has come back to them and use part of it to cover the deferred maintenance. They could have allocated a part of it themselves. Even though the state didn't separately line item money back to them for it, they could have used a part of it themselves. They could have used part of the property tax that they get from local sources to deal with it. So yeah, it's a shared responsibility. If you talk to somebody on the school districts, which I've done, if you talk to somebody on the school districts, they say, "Oh, it's all the state's responsibility. We put in these projects, they haven't funded them. The fact they're falling apart is the state's responsibility." And then you say, "But yeah, you could have put funds toward it." "Oh, well, I needed the funds for, healthcare for teachers, or for teacher, additional salaries for teachers, or for this project, or for that project, or for the other project." And so it's a shared responsibility. between the two. But regardless of how we got here, it's now a huge dollar figure that's beginning to come at us that we've got to deal with in some fashion.
Rob Myers makes the point. This deferred maintenance has been brewing for decades. We had a bunch of cash in 2013. We decided it was more important to build AstroTurf football fields. He's not wrong. I mean, everybody was asking for. I mean, the Fairbanks North Star Borough was at. Oh, we need Astro. I mean, if they've got an AstroTurf field in Barrow, we need one here. We need 3 here. I mean, it was just. I was just shaking my head like, come on, guys. There are better things to spend the money. And that was at the point where they still had tens of millions of dollars in deferred maintenance on other things. We should have been taking care of the buildings we had.
Well, yeah, and part of the problem is, the state was paying half of the construction of new schools. So, the local municipalities looked at it, or the local school districts looked at it as free money, basically, right? We can go out and we can favor our favorite architects. We can do our favorite contractors. They can all, get this money, and they can all get this money, and the state will pay half of it. Instead of contributing that money toward deferred maintenance of the buildings we already had. So we created more and more and more of the problem during that era by the state, paying for half of new school buildings and encouraging people to go out and build more and more and more, as opposed to taking care of what they already had. So it's a shared problem, but it's a big problem that's beginning to land on people's doorsteps. And again, it's the Senate who's getting forced into being the grown-up in the room, because the House hasn't dealt with it. The House hasn't talked about how to fund it. The House hasn't talked about the amounts, just like, boom.
Well, give me the Vegas odds. Give me the Vegas odds on what you think the Senate's going to actually step up and have to and do that? I mean, what do you think?
I think I have a lot of concerns about the Senate. I think some of them have good intentions. I think some of them are just like House members, in the sense that they just want to, curry favor with whatever constituency, whatever trade group they've got out there that, help fund their election. Some of the senators, I think, have good intentions. But, one of the things they could do is spend some time figuring out what's going on with the Permanent Fund Corporation. One of the things they could do is look at the type of deficient returns that we're getting out of the deficient, compared to where we could be, that we're getting out of the permanent fund. I mean, that's a revenue source. And frankly, the administration, the department, the commissioner of revenue ought to be looking at that, but he's off doing other things. He's getting ready to run for governor, so he doesn't want to be bothered by those things that's in his job description, And so we just got people just sort of running around and not doing the job. The Senate says they'll do the job. We'll see.
Brian said, but look at this new Center of Science-y stuff that we can't afford to operate, but it will look great on the brochure in color. I mean, that's typical. That's what we see all the time. Oh, but look at this. It'll be great. We'll put it up there. I mean, we finally fought for fiscal notes in the borough to finally, when I was there, to finally get, put on the fiscal note what the cost of keeping the building going was. That took a Herculean effort to get that on there. I mean, come on. We've got to know, great, you build the building. How much is it going to cost us in the next 10 years? And it's like nobody was thinking about that. It's like, once you build it, oh, now it's done. But we kept seeing the maintenance be deferred. I mean, the Fairbanks North Star Borough has $250 million in deferred maintenance for a government of 100,000 people, less than 100,000 people. $250 million. And this is, and remind me, who is the revenue commissioner? Adam Crum. That's who the revenue commissioner is, Brian, if you're asking there. All right, Brad, less than a minute. Final thoughts.
Michael, we got big issues in front of us, but people need to deal with it reasonably. This stuff that Rob Young's been through is just insane. We've got to have people who will take the time before they fire off crazy op-eds and must-read. We've got to have people who will take the time to actually understand what we've done in the past, and that Rob's just trying to continue what we've done in the past going forward. We need to reinforce those people who are trying to come up with reasonable sources of revenue, as opposed to castigate them every time that they open their mouths.
All right, Brad. Thank you so much, my friend. Good to talk with you. We'll see you next week.
Michael, as always, thanks for having me.
All right, folks, we got to go. That's it for us today. The Michael Duke Show, common sense, liberty-based, free-thinking radio. Hour 2 is right now.
Whoa, buddy. Put that thing back in its holster. We haven't gone anywhere.
I don't understand.
Check out the MichaelDukesShow.com for information on how to get access to the podcast.
Welcome to the party, pal.
The Michael Dukes Show.
The greed and the entitlement is astounding to me.
What more could you want from a low-budget radio program?
This is a dumpster fire.
That was just BS.
It is time to get a new perspective.
We know just what you need, and we've got just the cure. Open wide and prepare for a steaming hot cup of freedom.
I just don't fathom it.
The Michael Dukes Show, streaming live across the world.
Live around the world on the internet at michaeldukeshow.com and across the great state of Alaska on this, your favorite radio station and or FM translator. Good morning, my friends. Welcome to Hour 2 of the Big Radio Show. We've got more to talk about here. Welcome back to this beginning of the week for Tuesday. Did you miss me? Did you miss me yesterday? I actually ran into somebody that said I was in Soldotna yesterday, and somebody said, "Oh, you weren't on this morning." It was somebody. I'm like, "Yeah, I was." Oh, we missed you. Well, it feels good. Feels good, man. Feels good to know that we're getting missed on all this stuff. But let's dive into Hour 2 of the big show today. If you just missed the discussion we just had with Brad Keithley from Alaskans for Sustainable Budgets, you can go back and listen to it on the podcast wherever you find podcasts, or you can go back and watch it on Facebook or YouTube on the replay there, because there's some good stuff in there, including that chart on the management of the permanent fund itself, and the missed opportunity there. It's, when you look at the numbers, it's astonishing. Again, I'm not one that's in favor of necessarily giving government more and more and more money, but we wouldn't be in this crisis moment if we had, well, maybe we would be. I mean, the legislature has spent every available dollar and then some, so maybe it would be still a problem. But when you're talking about the difference between an $80 billion fund and the potential for a $180 billion fund, which is what the numbers show with what Brad was talking about in the investment, terms of investment for the permanent fund, that is a significant amount of money. We should be looking at that. We should be talking about it. And Brad's right; it should be a campaign issue for this next election cycle, where people are talking about we need to revisit and revamp the permanent fund board and the way that we're investing. I mean, if the Arizona or the Nevada PERS system, the public employee retirement system, is doing it with two people, just investing in an ETF fund, just investing in the S&P 500 or whatever they're doing, and is making money and able to do it. I mean, why are we spending nearly $1 billion a year on fees to get such a lackluster return in what's going on? It's crazy at this point. All right. So I want to talk a little bit about that. I want to talk a little bit about Rob Yunt's petroleum tax, the petroleum corporate tax bill. And I want to talk a little bit about the next thing that they're already talking about, which is now talking about the deferred maintenance on the schools, which is by law, the state has supposed to have been funding some of these things and hasn't been. But also there is a share of the blame that should be placed back on the school districts as well, because they have had the opportunity to deal with this and to continue to look to the state and just say, well, the state, it's just the state's thing. They're not being great stewards of our resources, of our monies, if that's how they're looking at it, quite honestly, in my humble opinion, or not so humble opinion. So let's take a look at this. Let's take a look at this piece that was in Must Read Alaska. Marcy Sowers has written it. And I had to agree with Brad that the headline on this, and I don't know if Marcy wrote the headline or if that was something from the editors of Must Read or what, but Senator Yunt talks like a tax-loving social justice warrior, not a conservative. My contention on this whole thing, when it comes to the S Corp, the Petroleum Corp, S Corp, the Hillcorp tax thing. Now, Rob doesn't want to say it's about Hillcorp, but let's face it, Hillcorp is the company that is utilizing this piece of law. They're the ones that saw the hole and said, well, there's no S Corp thing. We could make, we don't have to pay as much taxes if we. So they did. I mean, great, good for them. That's what they're supposed to do. They're supposed to look out for their owners, for their shareholders. If they're a public company, that's what they're supposed to do. Good for them. But at the same time, the whole point that I think everybody's missing, and I've already made it 2 or 3 times this morning, but I'm going to make it again. The whole point is that we are the owners of the resource. We, the citizens of the state of Alaska, we own the subsurface mineral rights in common. So we all own it together. And as owners of a limited, non-renewable, finite resource, we should be trying to get the maximum yield that we can from that resource as we let it go out the door. Right? I mean, would anybody disagree with me on that? As an owner, if you had an oil well in your backyard and you knew that it only had a set amount of oil, wouldn't you want to get the maximum return on that as you let it go out the door? That's what we're dealing with here. We're dealing with antiquated, maybe I don't know if that's quite the right word. Maybe that's a little too tough, but we're dealing with this tax system that was constructed and built even before we had S Corps. The S Corps didn't even exist when they first set up this tax structure. And so now, as times change, don't we need to revisit that? Because we're owners and we want to see the maximum return on our resource, on our owned resource. And Marcy goes through and talks about we need to doge the heck out of state government. I'm not disagreeing with that. I think she's 100% right. But the problem is that we have been attempting that route, I mean, on this show anyway, for the last 25 years. We've been talking about, cutting back on the size and scope of government. We talked about some of the waste, some of the things that could be done, things that we don't need to be doing, and it's not working. I mean, the very definition of insanity is doing the same thing over and over and over again. And again, maybe some of these people are just late to the party and just now they're saying, oh, well, we need to cut. We need to doge the heck out of Alaska. I'm with you. But the political will is not there to get it done. But even if we did cut back on the size and scope of government, let's just hypothetically say that I was able to take the magic chainsaw and just cut out whatever we needed out of government to make it, to make it better. As owners of a resource, don't we still want to get the maximum yield out of that? Don't we still want to get our maximum return out of that? And for all the fear-mongering about, well, then this will go to other corporations and it'll be all the corporations. Now, I know that there's some Democrats that talked about that. Brad mentioned that. But some of the Republicans were bringing that up early on. Some of the Republican folks who were squawking about it were bringing it up early. Oh, it'll always be. This was very specifically a petroleum corporation tax bill. And so, again, I don't understand a lot of the hand-wringing about it because this is our resource to get. We own it. don't we want to get the maximum return? Because once it's gone, baby. There ain't no more in the ground. I mean, once it's out of there, it's gone. Don't we want to get the maximum return? She goes on to talk about education systems failing. All we hear about is the government throwing more money at it. More government spending doesn't solve the inherent problems. I mean, again, I'm in agreement with so much of what Marcy's talking about here, in terms of the specifics of some of the different things in there. But the problem is her whole premise rests on the fact that we need to cut government spending. I would love to see. You have no idea what kind of joy it would bring to my heart if we were able to cut government spending. You have no idea. I would be over the moon. But the problem is that we do not have the fiscal will. We do not have the political will to get that done. There are a handful of people in this legislature who would support that. A handful out of 60. So at some point you have to, we can always talk about it. We can always talk about finding cuts in it, but you cannot hang your hat on that as the solution, because name me one time in the last 30 years in this state where we've actually reduced the overall spend. Name me one time where, even in the years of, the 26 to 2013, 2006, when we were in high cotton, we were printing money in this state. They were making so much money. They put billions of dollars away into the CBR. And the budget still went up. And then what happened in the following 5, 6, 7, 8 years? Well, we stopped it. The windfall stopped. And did we tighten our belt? Did we pull in our horns and say, okay, we got to batten down the hatches a little bit? No, we just continued on. And now we took all that excess that we put away, and over the course of 4 years, 5 years, we spent $16, $17, $18 billion out of our savings accounts. We had no fiscal discipline whatsoever. So this idea that, we could just cut, we just need to Doge. We just need, you're okay. Look, I'm a huge fan of Doge. I am huge fan of the Doge mindset. I'm glad to see what's going on. I'm glad that it's throwing people. There was an article in the paper today. Is it today? Talking about the university, or not the university, the museums, and how all the museums they brace for financial impact of the Trump's latest executive order. Or the museum, what did they say? There's over 100 and something museums in the state, and they're all funded by the federal government. Over 100 museums, each one with unique needs, and they get these reimbursable grants, and they do. Look, I said it earlier. I'll say it again. Everybody's going to feel the pain. Everybody's going to feel the pain on a Doge thing. I'm going to feel it. You're going to feel it. Somebody's ox is going to get gored in this deal. But if we don't do it, if we don't take care of it, if we don't bring the size and scope of government down, we're going to go off a fiscal cliff. And see, what history has shown us is that even with warnings, even with the heads up, and even with all that, people just ignore that stuff. They just ignore it until the worst happens. And then they're like, well, geez, why didn't we see that coming? And you say, but we did see it coming. Oh, well, we just didn't see it coming. That's what I'm afraid of, is that's what's going to happen here in the state, because we can talk about doging, we can talk about cutting back, but I have been talking about that for years, and there's no movement on it. Nobody's interested anymore in talking about it. That's, I like I said, I thought first and foremost, nowhere in the article does the headline of Yunt is a tax-loving social justice warrior get play, because usually if you got a headline, it references back to something in the article. There's nothing in there about social justice or anything. It's just a clickbaity headline, which I find weak sauce. But again, I think it's because many of these people, and including all the comments are all rah. All the, here's the thing. This is our oil. And as an owner, you damn well better want the maximum return for it. And if you are an owner, if you are an active owner of the resource, you should be looking at every opportunity to make sure that you are getting the maximum return for your finite resource. And if you look at it through that lens, I don't know anybody out there that wouldn't be like, if I painted the picture of this was pumping out of your own backyard and you initially set up your tax structure, 50 years ago when there weren't S Corps, and then somebody came in and they were using an S Corp and they weren't being taxed the same, you'd say, maybe we need to revisit that because again, I need the maximum return on my finite resource. I don't know anybody that would own something like that and would go, well, no, I'm philosophically opposed. You can just have it. That's how they need to look at this because we are owners. I understand that there's a balancing act between especially with the oil companies, between taxation and production and exploration and all those things. We need to find the best balance that we can. It doesn't mean that it needs to remain stagnant because we know what happens when it remains stagnant. It swings in one direction or the other, right? Either the state grows fat at the expense of exploration and everything else, or the state loses out, we lose out as a state, and the oil companies are taking in more and more money. There's got to be a balance. It's got to be revisited. Like I said, I don't understand. I just don't understand all the fervor over this because you have to look at it like you are a resource owner. That's how you need to be looking at it, in my not so humble opinion. Oh my, I'm about to talk about deferred maintenance. This should be interesting. We'll be back with more of the Michael Duke Show. Common sense, liberty-based, free thinking radio.
If you missed the show, you can listen to it on your time with Dukes On Demand. Oh, and it's free. Like America used to be. Streaming live every weekday morning on Facebook Live and MichaelDukesShow.com.
Lesko says Hammond wrote "Diapering the Devil" for a reason. 100%. 100%. Jeannie says I get pretty spun up about deferred maintenance as well. Yeah. Michael Chambers says the Sheffield administration cut 10% across the board 40 years ago. Okay, you're right. You're right, Michael. You are 100% right. Caught me on that one. When has it happened since then? Yeah, Kevin pointed that out as well. Thank you. Thank you. Terry says the oil and gas companies are here to make a profit. They're not here to be our goose that lays the golden egg. If Hillcorp is an S Corp, they pay taxes and royalties just in a different way. Don't kill the golden goose. Except they're not paying it in the same way, and they're not paying it to the same level as other petroleum companies in the state. And as an owner, are you just willing to let that go? If you were Terry, if you owned it directly, would you just be like, nope, let it go? Yep, they got us. Yep, they got us. We didn't have S corps when we set that up, but they got us, so we'll just let it go. If that was yours, would that be okay? I mean, I'm just asking. This is a good question, and I don't know the answer to this question, Kevin. Did Bob Hildebrandt form an S corp just to come to Alaska? That's a Hillcorp. Or is he an S corp, or was he an S corp before he ever came up here to rescue us from the departure of BP? I don't know. It's a good question. It's a good question. Was it specific or not? I'm assuming he had to form a corporation in Alaska to deal with it. Did they? I mean, again, I'm not blaming Hillcorp for finding the most profitable and viable way to do it. But I also can't blame the owners of the resource, or the legislature in this case as the managers of the resource, in saying, oh, we missed something, we have to go back and fix that. I'm scrolling back here. Whatever happened to the discussion on energy and Cook Inlet gas? Well, that's a good question, isn't it? I mean, I think they finally all decided we're just going to import gas, and the conversation kind of died immediately. Legislature said we're not going to touch it, and the utilities and everybody said we're going to import the gas, and that was it. That was it right there. Terry said, when you take days off, I never know what day of the week it is. And Anthony says, true story there, Terry. It absolutely blew my mind. I'm sorry that, and I did get a chance to see Frank on Saturday and Sunday at the dog races. Good to talk with you. Good to talk with you there. All right. I'm scrolling through here. Anthony's talking about the nightmare that is deferred maintenance at some of these buildings and the hoops that you have to jump through. He said the crushing amount of bureaucracy and hoops required to some of the most obvious crap needed would make your head explode. He says, hey, there's no heat in this building because nobody serviced the boiler in 9 years. It needs a $12 nozzle to get running again. The government says, cool, we'll have a committee meeting at the end of the fiscal quarter, present it to the purchase department leads, and process a request. We'll call you back in 3 to 5 weeks. That is the inertia of government. That is the inertia of government. All right, I'm just going through here. Willie just said, I was just reading where Tooksuk Bay jumped from the middle of the list to number 1 on the list for new schools. It's Rep. Jimmy's district. Methinks some votes were bought to get Nellie to vote yes on HB 16. You think? What? There's favor trading? Say that isn't true. Say that that's not true. That couldn't possibly be true. All right, I'm way behind on all the, Here we go. The Michael Duke Show. Common sense, liberty-based, free thinking radio. Let's do this.
The Michael Duke Show. Seriously humorous with a pinch of intellect. Sorry. That is humorous. Here's Michael Dukes.
All right. We're continuing ahead here this morning. Is deferred maintenance being used correctly on this show? Frank asks. Is the term deferred maintenance being used properly? Well, I don't know. This article in the ADN is interesting. Ira Samuels wrote this yesterday. Alaska lawmakers show renewed interest in funding maintenance for school buildings beset by, quote unquote, dilapidation. And it said they are showing renewed interest in addressing a backlog in school building maintenance in the wake of a report detailing the costly ramifications of years of underfunding school infrastructure in rural Alaska. Now, we could all argue that, well, wait, they've been funding schools. They've been spending money above. They've been doing one-time funds and everything else. But the truth is the state does have a fiduciary and a statutory responsibility to pay for some of the deferred maintenance and the back maintenance of these schools. And they haven't in a lot of ways. In fact, Iris goes on to talk about historically how the governor has vetoed over the last 10 years. Not Governor Dunleavy hasn't been there the last 10 years, but in the most recent 5 years, there's been a lot of regularly vetoed school maintenance funding in the budget. Now, some of that, I believe, as Brad said, this is a prioritization problem on the school side as well. They, because the school districts have not been great about managing their own maintenance. This was a problem when I was in Fairbanks, and I said this was a problem that was going to come back and bite us in the butt. And I said that 10, 12, 13 years ago. And here we are today, right? Here we are again with this huge, huge deferred maintenance deficit in Fairbanks and in every part of the state. I think if Rob Myers is still in the chat room, he'll correct me if I'm wrong, but I think that the current deferred maintenance bill for the entire state, across the entire state, is something like $10 billion in deferred maintenance. For $10 billion for a state of 700,000 people. But the Dunleavy administration vetoed school maintenance funding in the last 5 years. In the 5 years between 2011 and 2015, the state spent 111% of the recommended amount on school building maintenance. And it dropped in the most recent 5 years to 19% of the recommended amount. So the state does have a fiduciary and a statutory responsibility to do some of that. But also, I am not going to let the administrators or the school districts, the boards, whoever it is that's in charge of that, I'm not going to let them totally off the hook on this. They know that when you build a building, you have to budget for that maintenance every year. You have to put money in a budget to maintain, to update, to renovate, to improve systems, to replace things. It has to be done. I mean, again, when I was on the assembly those first couple of years, and we finally got a bill that we finally got it passed where they had to show you a 10-year cost analysis of what it was going to cost to keep a building. If you were going to build a new facility, you had to have a 10-year projection of what it was going to cost to keep that facility open. Because how else can you make a good decision? Oh, don't worry, the state's going to pay. Oh, worry, the feds are going to pay for it. Somebody else is going to pay for it. Okay, great. So somebody else is going to pay for some or all of it. But what does it cost us to keep it open in the long run? In the last few years, Dunleavy has vetoed school maintenance funding, including $21 million in 2021, $62 million he vetoed in 2022, and $10 million in 2023 that he vetoed for school maintenance funding. Now, that would be someplace where I would say, we've already invested the money. We, of course, should pay to keep it up for the upkeep. That would not be something that I would be against. And so I don't know why the governor vetoed those things, unless it was, of course, to try and balance the budget on something else, which is a form of deferred maintenance, I would argue. I mean, the whole idea of deferred maintenance, I'm trying not to get too wound up here because this is something that is just, I've often said there's a special place in hell for the guy who thought up the deferred maintenance thing. I mean, it's nutty. We have a building. We know what it costs to keep it going. And what we're going to do is we're going to spend that money that we would have spent on the building on some other project because we feel that that's more important. Well, what about the building? What about the thing? Well, we'll get to that later. You can only kick the can on that down the road. So especially in a subarctic environment, you can only kick the can on that thing down the road so long before you completely run out of road. So now they're talking about the backlog of schools and things like that. There was an investigation public by ProPublica and KYUK earlier this month that talked about different schools that were being, condemned One school in Sleepmood has apparently been condemned, but they're still meeting in it. Some schools, their HVAC system has failed and the kids are getting sick. And I mean, all this kind of crazy stuff. I mean, like, okay, this should have been handled a long time. And quite honestly, again, it goes back to the people who are on the ground, the people with boots on the ground, the administrators and the school boards. Why didn't they say, well, look, we're going to have to just pay for this and fight it out with the state later, because we can't let the school fall down around our ears while we're fighting over it. We should prioritize our spending to take care of the punch list on our, the things on our punch list that are absolutely critical. And then you got Jesse Keel, who comes in and is talking about this. And he says he hoped to address the top rural schools on the major maintenance list. Good for him. Thumbs up on that. But then he goes on to say he also wanted to lift the moratorium on school bond debt reimbursement, which is where the state pays for what, half? Was it 80%? Is it half? I can't keep track of it anymore. It used to be they would be like an 80% reimbursement. Now it is at half, whatever. The basically the state, you build a school in your community and the state pays for a big chunk of it. And remember, that's how we were sold schools for many, many years in these various communities, with no discussion on what the schools would cost in the long run for maintenance costs and all that, by the way. But, oh yeah, we need this. Look, it's free money. The state's going to pay a big chunk of this. We need this. And so we'll tear down a perfectly good school like Nordale that we were still paying bonds on for another decade after we tore it down because it had bonded stuff that was done to it. And we'll build another one in the same parking lot. We'll do that. That makes sense. Because it's free money, right? Free money. Because the state was going to pay for it. And then, oh man, things got tight. What was it, back in 97, 98 or something? And that was the first time that the school bond debt reimbursement didn't get funded. And everybody panicked. Because it's not a guarantee, folks. When there's no money, what are you going to do? And Jesse's bringing this up now when we have a $500 million deficit and next year's projected to be well over $1 billion deficit. You want to talk about bringing back this school bond, well, we're just shifting the cost 100% to local taxpayers and pretending we're not raising everybody's taxes. Well, the local taxpayers are the ones that are benefiting from the local schools. They're the ones that those are their kids, and I'm not seeing a problem here. As a taxpayer, I'm saying I don't see the fervor over this. I mean, at what point do you just go, there is no more money? You want to shoot. Wow. And I can't even remember how many millions of dollars were spent every year on school bond debt reimbursement, but considering a school is $30 million, and even if they're paying half of that every, with the paybacks on the bonds and everything else, it just makes no sense. This is the kind of thinking that's going on to me. This is like a snapshot of the thinking that's going on in Juneau. We're in a deficit. We got bigger deficits ahead. We got anything. What are we talking about? Well, let's open up the floodgates here and put back school bond debt reimbursement to increase that spend. What? How do you? I just what? Anyway, I just, as a business owner and somebody who's looking at these things and budgets and figuring it out, these are things that you factor in. The cost of maintaining these schools, the cost of maintaining any facility, any building, and the fact that you would put that off to spend on something else over and over and over again. A one-time thing, I could see maybe. Oh, something else took priority, The boiler blew up and we can't repair the leaky roof because at least, we got to stay warm at least. Okay. I could see it as a one-time thing. The problem is it's never ending. And that's how you end up with $10 billion in deferred maintenance across an entire state with only 700,000 people in it. All right, I kept a pretty even keel on that one. I thought I was going to spin up, but I kept it down. All right, we got to go. The Michael Duke Show. Common sense, liberty-based, free-thinking radio. Chris Story up next, right after this.
We're broadcasting live through a series of tubes.
Allowing all of these entities to provide streaming stuff going on the internet.
Well, it's kind of hard to explain. Sorry. Streaming live every weekday morning on Facebook Live and MichaelDukesShow.com.
Okay. All right. Contractors love that arrangement. Yeah. No, exactly. The new shiny thing, says Barbara. This is the truth, isn't it? The new shiny thing is always more glamorous than the fix-it-upper. Yeah. No, I'm with you. I'm sorry. I'm just scrolling back here, looking through some of the comments here previously. Okay, I think I was caught up to where I was. I'm still looking here. Jericho says, I'd like to see an actual breakdown of what maintenance was vetoed because it was necessary maintenance or resurfacing the running track that's covered by snow 6 months of the year. That's a good question, Jay. I don't know. That's a good question. What specifically was it covering? And she also agrees with me that it's not all the governor. There are plenty of other hands that had their hands on allocations. I mean, and even if you didn't get a maintenance allocation, you still did get money. And maybe as you should prioritize that to keep the building up and running, right? That, I mean, you'd think that, is it ever free money, says Tawny? No, Tawny, we all know that it's not. But isn't that the whole thing? My God, my dog is just like going through there. Anthony says, let me explain the logical fallacy of deferred maintenance. Building 1 has a yearly operational budget of X, but at the end of the year, the HVAC system didn't need repairs or maintenance for whatever reason. So the unused money goes somewhere else. This does not mean the HVAC system is going to make it till the next year. It still needs the repairs and maintenance, but now it can't because the money was allocated somewhere else. So now you need to cough up money beyond the operational budget. And it just gets shuffled around. It's a shell game, right? They move money from one project to the next, and they keep putting things off. And it's a money ball that you can never get a hold of. You can never get ahead of it. In Anchorage, school bonds do not have O&M, operational and maintenance costs included, but every school bond has the term for other purposes, which means the bond money can be used for any capital project. Which again is the danger of that kind of stuff. Faux show. All right, let's get Mr. Story on the line here on the blower, shall we? Get him all scored away. Come on. Nope. No. Didn't work. Be right back.
All right.
Story's like, what? And so be right back. Let's try this again. Let's try this. See if we can get this thing to work again. I mean, there we go.
Oh, nice.
Now
you sound like you're right in my head.
How now, brown cow? So it's all it all worked this time.
Show.
All right, Mr. Story. Soothe my savage nerves here. What's going on? What do you say? What do you know?
Well, I say a lot, and I say a lot more than I know. Just ask anybody. But today I was thinking we'd talk about committing to conflict.
Committing to conflict. Okay.
Mm-hmm.
All right. Well, give that a shot. I mean, I'm not.
It's like, isn't that your middle name?
Yeah, I
Isn't
said.
conflict your middle name?
I said I'm not against conflict. I just think that's great. So
Okay.
all right, we'll get you to it then. So hold the line here. Let me go back to the. Let me go back to the chat room here real quick. Willie says the state is retarded. Well, that was offensive. They need a boilerplate blueprint for new schools in the bush. Save over 20% on design. Screw fancy designs and high ceilings where heat is a huge cost going forward. Yeah, I mean, why would you create a big high cathedral ceiling space and all that kind of stuff if it costs $1 gazillion to heat it and everything else? And yeah, why do you need a specific design for each area? Why wouldn't you have a cookie cutter? Why wouldn't you have a cookie color? What color is a cookie? What cookie cutter design? Anthony says, Chris Story, the human manifestation of what would happen if Xanax in a sunny day became a living being. Good morning, sir. Good morning, sir. Oh man, interesting stuff. All right. We've got a 20-second gap here. We're getting ready to do it, and we are going to jump in. Why do they call it a blower? I don't know. Ask the British. Why do they call the hood a bonnet? I mean, why do they call it the boot? The trunk is the boot. Anyway, here we go. Jumping back into it. The Michael Duke Show.
The Michael Duke Show, proudly splitting the left versus right dichotomy. Yeah, I had to look that word up too. I don't think it means what he thinks it means. Here he is, though. That guy, Michael Dukes, the one with the show.
Okay, welcome back to the program. Hour 2 continues. We're finishing up with Chris Story, the man from Homer, who is going to come in today to talk with us a little bit about conflict and how we need to commit to the conflict. Good morning, Mr. Story. How are you, my friend?
Good morning, Michael. I'm fantastic. It's a nice, beautiful, snowy day, as you well know, here on top of the world. It's gorgeous.
It is a little snowy. So tell me,
Finally, winter.
Yeah, I'm not opposed to conflict, but why should I commit to it? What are we talking about here?
Well, I think sometimes we, euphemistically speaking, we avoid conflict because we don't want to argue. We don't want to rattle, the powers that be. I just want to go along, get along, leave me alone. I'll leave you alone, live and let live. We avoid conflict in a lot of areas of our life. We avoid conflict in public. We avoid conflict in interpersonal relationships sometimes at work, because I think to a certain degree, we don't understand what conflict is. Conflict actually helps you become a better person. It's sort of like iron sharpens iron. You become better when you question, when you have and engage in debate. But so often I think we are taught to believe that arguing isn't good. Sit down, shut up, do what you're told, versus how to debate, how to engage in a conversation whereby you might question authority. You might question the validity of doing something. I've been asked recently relative to my Fair Act tax reform. Somebody, a good friend, wasn't really trying to create conflict between us, but asked a really key question. And it's sort of in a nutshell was, what gives you the right to speak about property? I mean, other than the fact that you're obviously a real estate broker and so forth, but what gives you the right to think you could change tax policy on the Kenai Peninsula, let alone the state of Alaska? And I think it's not that I love conflict. It's not that I enjoy arguing. It's not that I enjoy debating per se, but I do recognize it actually strengthens relationships. And once you commit to conflict in a way that you actually want to resolve a problem, and you seek first to understand, then be understood, and you approach it that way, you actually make better decisions yourself going forward. And you actually create, to quote the leadership freak blog, he says, actually conflicts help you create better relationships. And my point there is, though, dependent upon how you go about it. If you go poke your finger in somebody's eye, you're going to get an expected result. But if you create conflict by asking questions, legitimate questions, and you question what's happening, you question your leaders, and you do it in an ethical way, seeking to create solutions, so much the better. I think that you're going to find courage to start asking more questions and debating in a more useful way if you commit to conflict in a useful way.
Well, and it sharpens your argument too. I mean, right? It helps you.
Absolutely.
It helps you to take a look at and maybe find some of the logical flaws in what you're talking about, and it helps you. It makes it better. I mean, it's the crucible of clearing off the dross and making your argument or your plan or your thing better. That's what it's all about.
I was had a really great discussion with the president of the South Peninsula Hospital Board yesterday, the operating board. And one of my points that I'm happy to state publicly, and I'll restate continuously, is I believe we need more public engagement. The board operates as a self-perpetuating, self-appointed board. You don't know who's on the board at any given time unless you're really hyper-focused on it. You don't pay attention. Nobody's paying attention to it. We're busy living our lives, and we just hope that the people that do stand up and volunteer are making the best decisions possible. But at some point, I think avoiding conflict by, in other words, not having to stand for election, not having to explain to the community, to the greater 15,000 members of the service area board, the service area, I should say, why you want to be on the board. You don't, if you're never facing any conflict like that, and you never face real scrutiny, you don't hold town halls, you don't have any sort of public interface, I think you, the board, are losing out, and ultimately so will the operations at the hospital. So will all of us who are consumers and constituents of this board. We all lose if you avoid conflict. I say, come to the community, be prepared. There's going to be some spitting mad people. There's going to be some pitchforks and some torches in the town hall. But I suggest a quarterly town hall where you sit and listen. Don't avoid the conflict. Run to it. Go to it and embrace it and say, look, we may disagree on certain things. 65% of you said no thank you to the bond. Understood. Let's hold some town halls and hear them. Why? Why did you do it? Instead, they're looking to buy more property, spend another $1 million on private property and convert it into public property. And I think they need to not avoid conflict, but embrace it and go about seeking change through conflict the right way, using it as something where you learn from it versus bash the other person.
Well, you would think that, especially if they lost that, and they lost that vote, again, 65% said no, you think the first thing that they would do is have some self-reflection on why. But instead, they just kind of proceeded ahead, and we're like, we're just going to keep doing what we're doing. Maybe somebody just...
And by isolating, the word you just used is very critical. And I'm not picking on the hospital board. I'm simply using this as an opportunity to explain the point about committing to conflict. You used a very key word. You used the word they. Well, what happens when you don't have a community type forum? You're not aired out on the radio. You never see interviews with the board members. You never see them in public holding real town halls.
Do people even know who the board members are? I mean, right? I mean, it's just kind of out of sight, out of mind.
And so you get the othering, you get the siloing, you get the they effect. Like, hey, they made this decision versus we. For example, this city mayor of Homer is going to be coming to our Board of Realtors meeting tomorrow, talking about the comprehensive plan. For all of its flaws, for all of its faults, for all of its ridiculousness, and $650,000 having been shipped up the road to the firm of Agnew Beck instead of spent locally, your tax dollars were just shipped in a pipeline up to this firm in Anchorage. Okay, for all of those flaws and criticisms that I got of it, it was a very public forum. It was done out in the open. It was decisions made by elected officials who aren't afraid of conflict. I can disagree with them, but man, they're not afraid of it. They just ran face into the fan. And I disagree wholeheartedly with the concepts. And Michael Jones has done an incredible job of outlining some of the stuff that's in the entire 2035 Comprehensive Plan report. I suggest everybody get a hold of that commentary through Heaven and Government over at the Regent Life Church, but 59 times climate change is mentioned in the new comprehensive plan. And I mean, but whatever, it was a publicly front-facing, forward, ready for conflict kind of event. And that's exactly what it should be. Anytime there's public dollars involved, anytime there's a constituency of the public, you can't avoid conflict. You got to run, embrace it, commit to it, and become responsible to the people you're reporting to.
Well, there's another example of people hate conflict, right? I mean, people don't like it. They don't want to challenge. I mean, but sometimes it needs to be done, especially when you're talking about public dollars and the quote unquote public good.
Yeah. In the facing, what are we going to look like in 10 years? What's the community going to look like? That's the idea of the comprehensive plan review and update. And yet we have advocated that to a firm out of Anchorage. Tell us what we should look like in 10 years. But again, my only point in bringing that up is to say, at least that process was very public, welcomed conflict, welcomed the idea of iron sharpening iron. And that's what I think we all need to take a closer look at in all areas and aspects of our lives. Where are we avoiding conflict, and what pain is it ultimately? All we're doing is avoiding. We're kicking it down the road. The pain's coming in the relationship. You can avoid conflict by, your muscles, conflict, lifting weights and exercising is conflict, and you're putting yourself in the way of pain. Do it now or you'll suffer later.
Did you just say no pain, no gain? Is that what you just said? No pain, no gain.
Bumper sticker.
Yeah, exactly.
That's it, man. And a bumper sticker. You got it.
Sounds like we should make a t-shirt out of that. But it's true. I mean, and there is pain in conflict. But again, a lot of times it sharpens the idea. It cuts away the chaff of any idea, and maybe things that you, as the person who thought of the idea, hadn't thought of. I mean, I'm sure you've discovered that here in the last 2 minutes. You could tell us you've discovered things in your plan that you didn't think about, unintended consequences, knock-on effects that probably somebody else brought up.
I go to each and every one of my agents at some point in our brokerage and say, "What can I get you doing better? What can I do to serve you? How can I help you?" And I think that's what leaders, that is the definition of true leadership is if you avoid conflict, you're kicking it down the road. You're creating dysfunction. I think avoiding conflict is actually a massive mistake wherever it is. And if you're operating in the dark, I think it's time to come out into the light. And, there's going to be some conflict, but if you commit to conflict now, you'll avoid pain later.
Yeah. So you heard
2 cents.
You heard it here first. Come out of the closet and fight is what he just said. So
I did not.
Yeah.
I did not.
He said, come into the light and embrace the conflict, which to me sounded a whole lot like come out of the closet and fight. Chris Story, the man from Homer. Thank you, my friend. As always, it's great to talk with you. We will catch you again next week.
Okay, look forward to it.
Don't forget, you can find him at ilovehomeralaska.com, where he's got his books and his audiobooks and everything else. We're out of time for today. Tomorrow, Rob Myers will be joining us, The Michael Duke Show, Common Sense Radio. All right, my friends. Well, this is a Monday. I mean, it's Tuesday, but it was not. I worked all day yesterday. I mean, who am I kidding? But it's good to be with you. And we will be back again tomorrow. So now you guys got your schedules all squared away, right? You don't have to worry about it. Yep. Be ungovernable. Keep things going on. Be kind. Love one another. Live well. We'll see you guys then. Have a great day.
We've shed our terrestrial radio skin, and now we are slimy lizard internet people. It's the Michael Duke Show.